Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, dividend yield. Income you can count on.
And it's just a phenomenal topic to dig into today, mostly because it is so widely misunderstood.
Yeah, totally. And, welcome to today's deep dive. I'm so glad you're joining us. Our mission today is to really unpack this financial concept that, well, it sounds like Wall Street jargon, but it's actually this critical shortcut to understanding your investments.
Right, because the stakes here are actually pretty high for everyday investors.
Oh, absolutely.
In a world where, everyone is just desperate for stable income and measurable returns, understanding dividend yield is basically the key.
Right.
It's how you compare entirely different companies or funds on a strict apples-to-apples basis.
Yeah, so before we jump into the math, and I promise it's easy math, we need to define exactly what this metric is and, why major financial institutions care so much about it.
Well, at its core, dividend yield, which is sometimes called the dividend-price ratio, is really simply the ratio of annualized cash dividends to the share's current market price. And that's expressed as a percentage.
Okay, so it's kind of like the interest rate on a savings account, right?
Sort of, yeah.
But here's the catch, and I'd love for you to clarify this. Since stock prices are, constantly jumping around, how does this actually fit into the total return on my investment?
That is the perfect question. The key is that the dividend yield only accounts for the income part of the equation.
Right.
It deliberately ignores the share price, changes the capital appreciation, It just isolates the cash flow.
Right, which makes it vital for, well, based on the Investopedia material we pulled, they call it the primary beacon for the income seeker.
Exactly.
Like if you just want stable income for retirement, you might not care if the stock price drops a bit on Tuesday, as long as that quarterly check clears.
Yeah, and the CFA Institute actually emphasizes this too. They note that the yield percentage is really the best way to compare income across different funds.
How so?
Well, if Fund A pays a $2 dividend and Fund B pays $5, Fund B looks better, right?
Raw dollars.
But if Fund B costs 10 times as much to buy, the raw dollar amount is completely misleading. The yield normalizes that math for you.
That makes total sense for the income seeker. But I want to pivot to the academic side of our sources because they talk about the forecaster angle, which blew my mind a little bit.
Oh, the FAMA in French research. Yeah, that's fascinating.
They showed that dividend yields actually have real forecasting power for long-term stock returns. But, how?
So it's about how the broader market prices risk. For the aggregate market yield to be historically high, stock prices generally have to be depressed.
Because everyone's terrified of a recession or something.
Exactly. The market perceives higher macroeconomic risk, so investors demand a higher expected return just to take on that volatility. That's the equity risk premium. And the Federal Reserve Bank of New York actually uses these exact dividend yields to estimate the cost of equity and expected returns in their macro models.
Wow, okay.
Yeah.
So the New York Fed is using the same basic metric we see on our phones. So since it has such powerful forecasting ability, let's talk about how you, listening right now, can actually calculate it.
It's a beautifully simple formula. It's just your annual dividend per share divided by the current share price.
Okay, let's do a concrete example. So if a company pays an annual dividend of, let's say, $1 per share.
Okay.
And I buy the stock today at $20 a share, my dividend yield is exactly 5%.
You nailed it. 1 divided by 25%.
But wait, here's my issue. Companies change their dividends all the time.
Oh, constantly. Yeah.
So which numbers are we plugging into this formula? Do I use the dividends they paid last year or what I think they'll pay next year?
And that right there is why there are actually 3 different types of dividend yields you'll see on financial platforms.
Oh.
First, you have the trailing dividend yield. This looks strictly backwards. It uses the actual cash dividends paid out over the previous 12 months.
So it's factual? The check's cleared.
Right, but past performance doesn't pay future bills,
Yeah.
So then you have the forward dividend yield. This swaps the historical data for an estimate of future dividends, usually based on Wall Street analyst projections.
Which introduces, human error. Analyst guesses.
Exactly. It can be overly optimistic. So the third type, which is kind of the pragmatic middle ground, is the indicated dividend yield.
What does that one do?
It takes the most recently announced dividend and just annualizes it. So if they paid $1 this quarter, it assumes $4 for the year.
Okay, that makes a lot of sense.
Yeah, and actually, Bloomberg's equity index methodology heavily leans on this one.
Oh, really?
Yeah, they calculate their indicated yield using the most recently announced gross dividend, and they just multiply it by the payment frequency.
Using the gross dividend, so before taxes are taken out, that makes sense for comparing international stocks.
Exactly. It gives a clean baseline.
Okay, so if a 5% yield is good, I want to talk about the dark side of this.
Oh, boy.
Because if 5% is good, an 18% yield must be incredible, right?
Mm.
Let's talk about the pitfalls and the dangers of chasing yield.
Yeah, assuming a massive dividend yield is automatically a good investment opportunity is probably the most classic pitfall in income investing.
The high yield trap.
Exactly. Because remember, the formula, we are dividing by the current share price. So a mathematically high yield could just mean the stock's price is absolutely plummeting.
Right. It's like buying a used car solely because it has a brand new, amazing stereo system,
Right.
completely ignoring the fact that the engine is currently on fire.
That is a perfect analogy. You are voluntarily buying a sinking ship. If the price drops by half, the yield doubles on paper, but the market is usually dumping the stock because they expect the dividend to be slashed imminently.
So how do we check the engine? If the yield percentage can just be a mirage from a falling stock price, what's the diagnostic tool?
The ultimate engine check is looking at the payout ratio.
The payout ratio.
Oh, yeah. This is the ratio of dividends paid to the actual earnings per share.
Okay, so out of every dollar in profit, how much goes out the door?
Exactly. If a company's paying out, say, $1.50 for every dollar it actually earns, they are literally bleeding cash.
Wow. Yeah. So they're funding it with debt or reserves.
Right, which means the dividend is completely unsustainable. It's gonna get cut.
And the CFA Institute actually brings up another warning here, right? You really have to read the fine print on how platforms calculate these yields.
You really do. It's about methodology quirks, specifically with special dividends.
Right. So let's say a company sells off a massive warehouse, gets a ton of cash, and hands it to shareholders as a one-time
A
bonus.
special dividend, yeah. Some financial platforms will blindly roll that massive one-time cash injection into their trailing yield calculation.
Which would make the yield look artificially explosive, like it usually yields 2%, but suddenly the screen says 12%.
Exactly. And you buy in thinking you're getting 12% forever, not realizing 10% of that was just a one-off real estate sale.
And other platforms exclude it entirely.
Right. So you have to know what methodology your brokerage app is actually using.
This is huge. Okay, so let's steer the conversation toward bringing this all together. Let's do a rapid-fire mental cheat sheet for everyone listening.
Let's do it.
Okay, first, yield is your dividend-price ratio. It isolates the income.
Right. And it's a crucial tool both for forecasting market returns and for comparing income across different funds.
Number 3, you need to know which numerator you're looking at. Is it trailing, forward, or indicated yield?
And finally, never fall for the high yield trap. Always check the payout ratio first to make sure they can actually afford the check they're writing.
Perfect. And if you want to keep exploring this, the expert and I highly recommend the resources we pulled from today.
Absolutely. The CFA Institute has incredibly rigorous breakdowns of these calculation methodologies, and Investopedia is just a fantastic trusted resource for the basics of payout ratios and sustainable income.
Before we go, I want to leave you with one last puzzle to ponder on your own. We've established that dividend yield is this huge part of total return, right?
Huge, yes.
But what happens to a portfolio's total return if a company decides to cut its dividend to absolute zero, just so it can reinvest all that cash back into growing the business?
Oh, that's the ultimate tug of war.
Right, like present income versus exponential future growth. It really forces you to figure out what kind of investor you actually are. Something to mull over this weekend. That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.